Welcome to our deep dive into the fascinating world of global finance. Today, we're embarking on a journey that trails the path of the Japanese yen, a currency that often dances to a different tune than the rest of the world's currencies. Throughout this journey, we'll be stopping at various stations: interest rate differentials, trade balances, economic growth, inflation, government debt, safe haven status, central bank policies, and global market dynamics. Each of these factors plays a unique role in shaping the strength and value of the yen. So, sit back, relax, and let's embark on this journey to unravel the complexities and intricacies that lie behind the movements of the Japanese yen. Our first stop, interest rate differentials. Let's dive right in. Ever wondered why Japan's central bank keeps its interest rates so low? Well, that's a tale that takes us back to the 90s. After the asset bubble collapse, Japan found itself grappling with a sluggish economy. One of the strategies the Bank of Japan employed to combat this was setting interest rates at rock bottom. Low interest rates, you see, are a lure for borrowers, stimulating spending and investment, and in turn, giving the economy a much-needed jolt. Now, let's bring the Japanese yen into the picture. Interest rates play a significant role in determining the strength of a currency. This is where the interest rate parity theory steps in. According to this theory, if one country's interest rates are lower than another's, its currency should weaken. The logic here is quite simple. Lower interest rates offer lower returns on investments, prompting investors to seek higher returns in other currencies. So, what's the result? With Japan's interest rates staying low, investors often look for better returns elsewhere, implying a potential outflow of capital. This, in turn, puts downward pressure on the yen. So, low interest rates often lead to a weaker yen as investors hunt for better returns elsewhere. Japan's status as a major exporter plays a big role in the value of the yen. As many of you know, Japan is a global powerhouse in industries like automobiles, electronics, and machinery. These exports pump extensive funds into the country, creating a trade surplus. Now, a trade surplus typically strengthens the currency, and in this case, the yen. But remember, the world of trade is dynamic, and so are its effects on currency. Global economic trends can cause fluctuations in Japan's trade balances. For instance, a global recession or a slowdown in key markets could reduce the demand for Japan's exports. Similarly, an increase in Japan's imports, say due to a surge in oil prices, could tip the scale towards a trade deficit. According to the balance of payments theory, these changes in trade balances can directly impact the value of the yen. A dip in exports or a rise in imports could weaken the yen, while a boost in exports or a drop in imports could strengthen it. Therefore, strong exports usually buoy the yen, but changes in trade balances can also weaken it. The health of Japan's economy is a key influencer of the yen's value. Like any country, Japan has seen its share of economic peaks and valleys. Particularly notable was a stretch in the 90s known as the Lost Decade. This was a period of economic stagnation that had far-reaching effects, not least of which was a significant impact on the yen. During this time, the Japanese economy was virtually at a standstill. Despite efforts from the government and the Bank of Japan, the country couldn't seem to regain its footing. This led to a cycle of falling prices and low consumer spending, further hampering economic growth. Now, why is this important for the yen? Well, a stagnant economy can lead to reduced investor confidence. Investors are always on the lookout for strong, thriving economies to put their money in. When an economy is struggling, as Japan's was during the Lost Decade, it becomes less attractive to investors. This can result in a decrease in demand for the country's currency, thereby weakening it. So as we can see, the health of an economy is intertwined with the strength of its currency. Economic stagnation can lead to reduced investor confidence, potentially weakening the yen. Japan's unique struggle with deflation also impacts the yen. Now you may be wondering how this can be. To understand this, we need to delve into the world of purchasing power parity, a theory that suggests currencies should equalize in purchasing power given different inflation rates. Let's take a step back and look at Japan's economic landscape. For years, Japan has been grappling with deflation, a situation where the general level of prices is falling. This is a challenge for any economy because it discourages spending and investment, which can lead to economic stagnation. According to the purchasing power parity theory, a country experiencing deflation should see its currency strengthen. This is because as prices drop, each unit of currency can buy more goods and services, increasing its purchasing power. So in theory, Japan's deflation issues should result in a stronger yen. But here's where things get interesting. Despite deflation usually suggesting a stronger currency, Japan's ongoing economic challenges can sometimes lead to a weaker yen. The country's struggle with low growth and high debt levels, for instance, can discourage investors, thereby putting downward pressure on the yen. It's a complex interplay of factors that shows just how multifaceted currency valuation can be. High levels of government debt can pose a risk to a country's currency. Now, this statement rings particularly true for Japan, which is known to have one of the highest levels of government debt in the world. This debt, expressed as a percentage of gross domestic product, has been on a steady incline for decades, largely due to persistent budget deficits and the cost of servicing existing debt. A towering debt pile is often viewed unfavorably by investors, as it could signify a country's potential inability to meet its financial obligations. This can lead to a drop in foreign investment, which in turn can weaken the currency. Moreover, high debt levels can also trigger inflation. As a government prints more money to pay off its debt, the increased supply of money can lead to a decrease in its value. So, in the case of Japan, high debt levels can trigger inflation and deter foreign investment, leading to a weaker yen. In times of global instability, the yen often becomes a safe haven. But what exactly does this mean? Well, a safe haven currency is one that's considered stable and reliable during times of economic or political uncertainty. Investors flock to these safe havens because they're looking for a secure place to park their money until the storm passes. Now, the yen fits this description rather well. Japan's political stability, resilient economy, and the Bank of Japan's low interest rate policy all contribute to its safe haven status. So, when global markets become volatile and unpredictability reigns, the yen usually sees a surge in demand. This increased demand pushes its value up, leading to an appreciation of the yen. But remember, while safe haven currencies offer a level of security, they're not immune to fluctuations. They're still subject to the same market forces and economic trends as other currencies. As a safe haven, the yen attracts investors during global instability, appreciating in value. The strategies of the Bank of Japan have direct implications on the yen's value. Now, one of the key tools in the central bank's arsenal is monetary policy. This encompasses a range of strategies, among which quantitative easing has been a prominent one. But what exactly is quantitative easing? In simplest terms, it's a method used by central banks to inject money into the economy. This is achieved by buying government bonds and other financial assets from commercial banks and other financial institutions. The idea is to increase the money supply, stimulate economic activity, and combat deflation. Japan, grappling with economic stagnation and deflation, has been a high-profile user of this strategy. The Bank of Japan has pumped trillions of yen into the economy over the years, hoping to invigorate growth and inflation. However, there's a catch. When a central bank increases the money supply, it usually leads to the depreciation of the currency. This is because more money chasing the same amount of goods and services can reduce the value of each unit of currency. So, in the case of Japan, quantitative easing has often exerted downward pressure on the yen, Expanding the money supply typically depreciates the currency. The yen doesn't exist in isolation. It is influenced by international market trends. Let's dig a bit deeper and see how global market dynamics, specifically changes in the US dollar's power, can impact the yen. Visualize this. You're at a lively international market. The represent countries, the traders, symbolize investors, and the goods exchanged are currencies. Now, envision the US dollar, one of the most exchanged currencies, abruptly being discounted. This could be as a result of domestic crises, such as political instability or an economic downturn. Investors may decide to offload their dollars and search for more lucrative currencies to invest in. This is when the Japanese yen steps. Viewed as a major global currency, it's frequently considered as a feasible substitute to the dollar. Hence, if the dollar investors might procure yen instead, leading to its value increase. This occurs not necessarily due to Japan's economy faring well, but rather due to shifts in the international market dynamics. Conversely, if the US dollar fortifies, investors might discard their yen to acquire dollars, leading to the yen's depreciation. Yet again, this isn't necessarily an indication of Japan's economic performance. It's all a part of the global currency market's ups and downs, and it's not only the US dollar that can affect the yen. Economic progress in other major economies like the Eurozone or China can also sway its power. By comprehending these global market dynamics, we can obtain a more lucid understanding of why the yen fluctuates and how it's interconnected with the rest of the world's currencies. So, if the US dollar weakens, the yen may augment, not necessarily due to Japan's own economic performance. Conclusion: we've examined numerous factors that dictate the yen's value, ranging from interest rates and trade balances to economic health and inflation, from government debt and safe haven status to central bank policies and global market dynamics. It's evident that currency valuation is a multifaceted interaction of several factors. Remember, this information is meant to enhance your understanding and does not act as financial advice. Use it judiciously. Before we wrap up, it's crucial to note that the information provided in this video is intended to enhance your understanding of the complex factors influencing the value of the Japanese yen. It is not by any means financial advice. Economic dynamics are intricate and unpredictable, and they should be navigated with caution and professional guidance. Use this information at your own risk. Also, remember that while we've used the US dollar as a primary example, the yen's value can be affected by a multitude of factors, including the economic health of other nations. Therefore, a holistic view of the global economy is necessary for a comprehensive understanding. Now, having understood these caveats, let's move on to our final thoughts on the journey of the Japanese yen. Having embarked on a fascinating journey, tracing the path of the Japanese yen through the complex world of global finance, we've now reached a point where we can pause and reflect. We've delved into the intricacies of interest rate differentials, trade balances, economic growth, inflation, government debt, the yen's safe haven status, and central bank policies. Each of these factors plays a significant role in shaping the yen's value. However, it's crucial to remember that these factors do not exist in isolation. They are interconnected, influenced by a myriad of global economic dynamics. Understanding these dynamics and how they impact the yen is a continuous learning process, one that requires curiosity, diligence, and an open mind. To truly grasp the journey of the Japanese yen, one must also comprehend the economic health of other nations and the global market dynamics at play. It's a vast and intricate web of connections, one that is continually evolving. We hope this video has sparked your interest in the world of finance, specifically in understanding the factors that influence currency values. We encourage you to continue exploring, continue learning, and continue growing your financial knowledge. Thank you for joining us on this journey. We hope it has provided you with a deeper understanding of the Japanese yen and the factors that influence its value. Until next time, keep exploring, keep learning, and keep growing your financial knowledge.